This video will look closer into the accounting for prepayments. If you missed our previous video on the accrual basis of accounting, you can check it in the description below. This is one of the major adjusting entries you need to look out for because depending on what type of accounting you use to record it, it has a chance of misstating your expenses if you missed adjusting it. We will talk about what are the two ways of accounting for prepayments and how to adjust them correctly. Welcome to Accounting Zero to Hero. We are here to help you understand the fundamental accounting concepts through simplified technical discussions and practical applications of the accounting standards. All of this to help you go from zero to hero. Now let's go back to the video. Prepaid expenses belong to the four types of adjusting entries under the accrual basis as previously discussed. These result from transactions wherein the company pays in advance for something that is yet to be used or the usage extends to the next accounting period. If you are solving for accounting problems as a student, you need to remember that prepaid expenses will disguise itself in the regular transactions within the year, and if you're not careful in remembering that the transaction you did is a prepaid expense, then you're going to have an incorrect trial balance. My suggestion is that you mark the transaction date so that you don't forget to adjust this prepaid expense. Now let's look at the timeline of the life of a prepaid expense. Let's assume that this financial company has a regular financial year end of December 31. During the year, the company will pay for something in advance. For example, let's say that the company paid for a whole year of rent amounting to $12,000, applicable for the 12-month period from April to March of the next year. There are three significant dates in this transaction that you need to watch out for. Number one is the payment date. This is where you initially recorded the prepayment. The year-end date. This is where you need to do adjusting entries because you need to prepare the financial statements. The end date of the contract. This marks the end date of the transaction. There are two possible ways prepayments are accounted for during the payment date, and the selection will normally determine your analysis on what adjusting entry to do. First, we can account for everything as an asset. Upon payment, we debit an asset we generally call as a prepayment in credit cash. This one is a better option because it recognizes that the $12,000 has future economic benefits because it has not yet been used. Therefore, it's an asset. The second way is also acceptable in practice where we recognize everything as an expense all at once. This is acceptable because at this point, we are not preparing any financial statements and we rely on the fact that we will eventually adjust this by year-end before preparing the trial balance. Now for both methods of accounting, let's look at your T accounts. The first method shows the full $12,000 in the balance sheet, and the second method shows the full amount in the income statement. Now during year-end, you need to do an analysis of how much rent did we actually use. In this case, since we started rent during the month of April, we have 9 months of rent used during the year. The amount of rent used during the year should be your expense portion, no matter what method you have used to account for it during the payment date. And the remaining should be the prepayment portion as at year-end date. Now, you should translate this understanding to an expectation of what your T accounts will look like after the adjusting entries. This expectation will help you determine what adjusting entry to do no matter what type of accounting was done during the payment date. In this case, after adjusting entries, we need to have a total of $9,000 rent expense in the debit side, representing the amount of rent used up, and a total of $3,000 of prepaid rent in the debit side, representing the amount of rent from January to March of next year. So if you initially accounted for the whole amount as an asset, all you need to do is to remove that $9,000 portion through a credit in the prepaid rent and debit it to rent expense. Easy peasy. And if you recorded everything as an expense, all you need to do is credit that rent expense for $3,000 and debit that amount to prepaid rent. You will notice that both adjusting entries are different, but the end results are the same because we already established the expectation early on in the analysis. Now, if your prepayment extends only up to the end of the accounting period, just do not forget to adjust this remaining $3,000 when preparing for the next year's financial statements. All you need to do is to credit the prepaid rent and debit rent expense by March 31, the last period of the rent paid in advance. Other normal examples of prepaid expenses are prepaid insurance and office supplies. So this is it for this short video. I hope that by now you can put all of these knowledge to good use. If you want to get more accounting related content, don't forget to subscribe and click the notification bell. See you!